Hello and welcome. I'm Devon Coombs, CPA, MBA, ex-Google and ex-Deloitte, and lecturer at San Jose State, as well as a top consultant in the Bay Area. Today, we're going to kick off my lecture series on valuation theory. Have you ever wanted to know if you were getting a good deal on a house or a car, or wondered how legendary investors like Warren Buffett identify undervalued companies for long-term growth? The answer to all of these questions lies in the discipline of valuation. At its core, valuation is the process of determining an asset's intrinsic worth, or value. This is distinct from its price, which is the amount it trades for in the market. The goal of a rigorous valuation is to estimate an asset's true value to see if its market price is fair. From a theoretical standpoint, there are three primary ways to do this. The first method is grounded in accounting and is often called the cost approach. In cost accounting, we learn that the cost of any manufactured product is a sum of its parts. Direct materials, the raw goods that go into the product. Direct labor, the wages of those who directly create the product. Overhead, all indirect costs such as electricity, facility rent, and indirect labor. Once you've assigned a total cost to each unit, you add a desired profit margin. For example, if it costs you $2 to make and serve a cup of coffee and you want a 25% profit margin, you would price it at $2.50. This approach establishes a price floor, the minimum you can charge to avoid losing money. Caveat: the practical application of this method is often limited to specific contexts, like insurance valuation, construction projects, or unique assets with no active market. Furthermore, for assets with significant intangible value, like a strong brand, the cost to create or replace them is often unrelated to their true economic value. The second pricing theory comes from economics, based on the law of supply and demand. The point where supply and demand meet is the market equilibrium price. From a practical perspective, we see this theory in action through comparable pricing, or comps. We use this approach constantly. For example, in real estate, a house's value is largely determined by the recent sale prices of similar houses in the same neighborhood. In practice, this requires adjusting for key differences in size, quality, location, and time of sale to ensure the comparison is valid. In business valuation, like mergers and acquisitions, companies are often valued using price multiples. For instance, if pet stores typically sell for 5 times their annual earnings, a store with $100,000 in earnings would be valued around $500,000. It's vital to remember that while the market price is a powerful indicator, it can temporarily deviate from intrinsic value due to factors like investor sentiment, market liquidity, or regulatory changes. This is especially true when analyzing volatile assets. This leads us to what many consider the most robust method for valuation: the income approach, based on the theory of discounted cash flows, DCF. The core principle is the time value of money. A dollar today is worth more than a dollar in the future. A DCF analysis calculates an asset's intrinsic value by projecting all the cash flows it is expected to generate and then discounting them back to their present-day value. To do this, you need 3 key inputs. First, future cash flows, the money you expect the asset to generate. Second, discount rate, the rate of return required to compensate for the investment's risk and opportunity cost, the return you forego by investing in this asset instead of another. Third, time period, the duration over which you'll receive the cash flows. The result is what the asset should be worth today based purely on its future earning potential. Let's use a single example: buying a house, to see how all 3 methods work together. First, we could use the cost approach. To do this, we'd calculate the cost to build the house from scratch: land, materials, labor, overhead, and a builder's profit. This gives you a baseline value for the house. However, in most instances, this is not practical and won't be used unless you are a sophisticated investor in the space. For example, a commercial real estate investor may take this approach. More realistically, and what most people use, is the market approach. To do this, you could just look on Zillow or Redfin for comparable sales, making careful price adjustments for differences in house sizes, quality, and neighborhoods. This would tell you the current market price or comparable price. Now, to figure out if you got a good deal compared to the market price, you would use the income approach to determine the house's intrinsic value. To do this, you would project its future cash flows. If you plan to live in it, this cash flow is the rent you would save, known as imputed rent. You then subtract annual costs like taxes and maintenance. After projecting a future sale price, you would discount these cash flows back to today using an appropriate discount rate. To determine the appropriate discount rate for this calculation, you could look to a variety of different benchmarks, from the stock market's average return less inflation to, if you own a company, the company's weighted average cost of capital. Throughout this lecture series, we will go into each of these theories in detail, so watch more and subscribe to keep learning. When comparing the intrinsic value to the market price, it's important to separate the financial calculation from the intangible lifestyle value, the personal enjoyment and utility you get from the home, which isn't captured in a DCF, but is a real part of your decision. In practice, anchoring an analysis across these three disciplines provides the most complete picture. The cost approach provides a floor, the market approach provides a real-world sanity check, and the income approach provides a fundamentals-based intrinsic value. While a balanced approach is ideal, the type of asset often dictates the primary method. For example, a pre-revenue startup with no cash flows relies on market comps, while an income-producing property is best measured by a DCF. Understanding these theories provides a solid foundation for any investing or financial decision. Here are some key takeaways I want to leave you with. First, value versus price. Value is an estimate of an asset's intrinsic worth. Price is the amount it transacts for in the market. Second, the three pillars of valuation. It stands on three legs: the cost, market, and income approaches. Third, that these valuation methods provide complementary roles. The cost approach sets a floor, the market approach provides a reality check, and the income approach seeks to determine fundamental value. Fourth, that context is king. The most appropriate valuation method depends heavily on the type of asset, its industry, and the availability of data. Fifth, that markets aren't always right. Market prices can diverge from intrinsic value due to sentiment, liquidity, and other external factors. Value investors use tools like discounted cash flows to determine if prices are too high, meaning they should sell, too low, meaning they should buy, or fairly priced in order to make long-term investments that beat market averages. Sixth, all of these methods require estimates and judgment. No one can tell the future, but these tools are extremely helpful in sizing potential risk and returns for investments. Thank you for watching. In the following videos, I'll cover explicit examples of how to calculate a variety of assets using these tools, from financial assets like bonds and stocks to physical assets like houses and cars. Have a great day.